Every candlestick you see on the chart is telling you a story, and mastering them lets you read the market like a book. When it comes to technical analysis, three of the most important things you should pay attention to, amongst others, are: number one, market structure; two, liquidity; three, price action. Now, candlestick is the language of price. See, when you're looking at candlestick that is on the chart, you are simply looking at market psychology. It tells you who is in control between the buyer and the seller at a particular period of time. Each candlestick represents the historical price movement of a currency pair or an asset for that particular period of time, which can be monthly, weekly, daily, hourly, in minutes, or even in seconds. Okay? Each candlestick gives four different types of informations. We have the open, the close, the high, and the low. Okay? Equally, we also have the body, the wick, and the color. Now let's take it one after the other. The open, it tells us the opening price at the beginning of the period. Now for the close, it tells us the price at the end of that particular period, the closing price at the end of that particular period. Now for the high, it tells us the highest price that price ever gets to during that period. Now for the low, it tells us the lowest that price ever got to during that period. Equally, the body, this is a thick part between the open and the close of the candle. We have the wick. Okay, it is a thin line above and below the body. Now the color, you see, in most charts, normally they make use of the green and the red color. Now when you see a green color, it signifies bullish momentum or bullish movement. Okay, now when you see the red, it signifies bearish momentum or bearish move. Now looking at this diagram before us, we have two candles, the green and the red candle. Now for the first one, which is the green candle, it normally opens at the bottom. This is the opening price, exactly where it opened. Okay, now when it opened, the sellers pushed the price to the downside. That's why you're having this wick that is here. Then the buyers now reverse the price back to this highest point where you have the wick. Okay, sellers now push the price down. That's why it closed at this particular section over there. Okay, so what you are seeing at the up side is called the wick. The downside is called the wick. Okay, now this green portion that is in between both wick is called the body. Okay, that's the real body. Now equally for the red candle, we have this side, which is the red candle. It normally opens at the top. Now this particular candle opened at the top. The buyers tried to drive the price up. Sellers rejected it while you're having a long wick at the top. Now they push the price down to close at the lowest part of the wick. Buyers rejected it and pushed the price up. That's why the price now closed at this particular section now. So it's typically explaining the tug of war between the buyers and the seller. Okay, now we have three categories of candles. Okay, the first one, single candle patterns; the second, double candle patterns; the third, triple candle patterns. Okay, now these are all patterns of candlesticks, and you will be familiar with them. When we go to the read charts, you will see how these candlesticks normally operate or works. Okay, now for the single candlesticks pattern, okay, that's where we have the hammer. As you can see, this is the hammer here. This is the hammer. Next, we have the inverted hammer, which is this. We have the dragonfly doji, which is the next one. Okay, then we have the bullish spinning top, which is this. Next, we have the hanging man. Next, shooting star. Next, gravestone doji, and the last one, bearish spinning top. Now all these ones they're under the single candle patterns. Okay, now if you look at the single candle pattern, you will see, like from the dragonfly doji. Okay, let's go to the hammer, for instance. Now you see about three candles that were going down. Then all of a sudden you see a reversal candle, which is the hammer. It simply signifies that the buyers are trying to step into the market to take it from the sellers. Okay, same thing with inverted hammer. Okay, it simply signifies that the buyers are trying to step into the market. Okay, so these are all single candlesticks pattern. Okay, so next we have the double candle pattern. Number one on the list is bullish kicker. Second, bullish engulfing. The third, bullish Aromi. The fourth, pitching line. Tesla bottom, bearish kicker, bearish engulfing, bearish harami, and the dark cloud cover. Okay, now these are all double candle pattern. Now for the last one, we have the triple candle patterns, which is morning star, bullish abandoned baby, 3 white soldier, 3 line strike, morning doji star, bearish abandoned baby, 3 black crow, evening doji star, and the evening star. But we apply this concept in order to stay profitable. Okay, 1, most traders look for certain candlesticks pattern before entering into a trade. Okay, number 2, the formation of these candles are not enough unless it has the following. Number 1, it's occurring at a certain key levels. Number 2, it has follow-up candles from forming higher highs and lower lows. Now, to wrap up this video, I would like to talk about an engulfing candle. Okay, now this is a candlestick pattern that engulfs the previous candle. Now, looking at the charts in front of us, what we are seeing right here is an engulfing candle. Okay, this particular green one over here, because it engulfed the previous candle before it. So, as a trader, once I sight an engulfing candlestick pattern occurring at a particular support level, immediately I enter into that trade. Now, this gives me a good risk to reward ratio. Okay, now I hope this video has been of help to you. If you are not yet subscribed to this particular channel, please kindly subscribe, turn on your bell notification so you'll be the next to be notified whenever I upload a new video. Now till I come your way again, remain blessed and shalom.